It's wonderful to be here with Ben Senn from Valhalla Network. And yeah, I've known Ben for a little bit of time. He's one of the acolytes of Professor Richard Werner. And it's going to be really exciting to hear more about what he's working on and his thoughts on quantitative easing and credit creation in DeFi.
So thanks very much for the warm intro. Like you said, we are all followers of Wernernomics in the SORA ecosystem, and the same goes for Valhalla Network. Just a brief description of Valhalla. We are a DAO that is intending to perform the governance for a set of small and locally owned community banks in the Eurozone. The intention there is to allow for credit creation that is used for productive purposes and performs lending for the real economy to help small and medium-sized enterprises grow productively, which is something that is sorely lacking at the moment in the Eurozone. Anyway, let me get into the talk. So today I'm going to be talking about quantitative easing and credit creation in DeFi. Now, first, let me just say what this talk is not going to be about. Is not going to be focusing on stablecoin credits and how credit is created there, how equilibria form, and how unstable equilibria can lead to some kind of deleveraging spiral. This has actually been the topic of a very similar talk by Simon Meyer from the University of Chicago that I was lucky enough to see in person in June at the Future of Money conference by the École Polytechnique, hosted by Julian Pratt's department. They have done some really interesting work on CBDC specifically and have been looking into what the effects could be there in interoperability standards with the DeFi ecosystem. Now, that is where I, as a practitioner in DeFi, like to focus my attention. I will be talking about the legal environment and taxonomy that cash-like digital bearer assets currently find themselves in. So that specifically is referring to any privately issued currency, but of course, the bearer asset side refers specifically to crypto assets. Because if you have a non-custodial wallet that you host your, such as the Fearless wallet, that you host your cryptocurrency on, it is a bearer asset and is not credit-based as you have in the conventional banking system. Right, so let me get to the table of contents, just to format how I'm going to be speaking today. So firstly, I'm going to be speaking a bit in the macro picture about reserve currency status and why the sort of dollar backing, you see this as well in the stablecoin system, why dollar backing has really, really profound effects on how credit is created, what the Eurodollar system is and why that is really important for bank credit creation as well in the banking system, and what effects that can have on the DeFi ecosystem. Then I'm going to speak about quantitative easing and the quantity theory of disaggregated credit. Now, this is one of the theories of Professor Werner that he has worked on intensely. It's probably one of the first empirical studies of sort of monetarist economics and how money is created, because he did it empirically in 2014 at a bank, seeing how the balance sheet actually reacts to loans coming in, being underwritten, deposits coming in. And some of the findings are slightly counterintuitive. I will not be going into that in this talk, but my colleague Borja Clavero will be speaking next. He has really, really great insights into the legal specifics of how the current account works and what specifically is happening mechanistically when banks are allowed to create credits. Then I will go more specifically into the fintech element. That is the CBDC, systematization of knowledge, where I will be referring to some of the work that has already been done, talking about Simon Meyer's work with the IFO Institute, where he has spoken about credit creation with stablecoin dynamics. Then I will also be looking at Martina Froscini's work about central bank digital currency and quantitative easing. Again, this does not refer to DeFi basically at all, but there has been some preliminary work by Java Shu at the University College London about how money market lending works in DeFi, and that actually makes some reference to Professor Werner's work, which I'm excited to share with you. Then we will be talking a bit about a potential synthesis of these ideas that Makoto has written about in The Case for ZOR. And I think that there are some useful points that we can draw from that. But first, let me go now into reserve currency status and why this is relevant when we're talking about the banking system. So the source text for this is Professor Barry Eichengreen from the University of California, Berkeley, and his book, How Global Currencies Work. Now, this was written in 2017, so already there have been some developments since then that might date it. But in its core, what it's describing is the way that there is always one reserve currency, and how that may not be the case necessarily in the future. So between roughly 1936 and 1941, there was a transition from a British pound reserve currency status to US dollar reserve currency status. Now, probably the most concentrated reserve currency status ever was in the early 1900s, the British pound. Something like 80% plus of all world trade was indexed in pounds prior to the First World War. That transition to the dollar saw the reserve currency status slightly less concentrated in the 1990s. I think its peak, it was around 70 to 75%, and that number has been gradually decreasing since. Now, this has led a lot of people to hypothesize that there's going to be some kind of alternative reserve currency system with the Chinese yuan backing all of global trade. I think this is a slightly oversimplified theory, and I'd like to speak later when we talk about DeFi why this hopefully is not necessarily the case, and calls for the dollar's demise are somewhat preemptive at the moment. So let me just give a definition of global reserve currency status. So firstly, it speaks about there being main foreign exchange holdings at central banks. This is also known as the repo market, aka central bank repurchase agreements, standing repos. These can be somewhat counterintuitive because nominally there is a repo between the Federal Reserve and the Eurozone, the Federal Reserve and the Swiss National Bank, or the Federal Reserve and the Bank of England. That means that if there is a liquidity shortage in pounds or dollars, the Bank of England will be able to provide pound liquidity to the Federal Reserve, and in exchange, the Federal Reserve will be able to provide dollar liquidity to the Bank of England in cases of sort of extreme volatility. Now, in reality, the case is that actually there has basically never been any shortage of liquidity in US dollars. So this is very much a one-way system. All repos basically extend from the nexus of the banking system. For central banks, that would be the US dollar Federal Reserve System, out to peripheral central banks. And in the 2008 financial crisis, we saw a very strong correlation between your ability to maintain solvency in your banking system, in the national economy, and access to dollar repos. Now, this reduces exchange risk for the reserve issuer. What this means is that there is very little sovereign bond risk or sovereign exchange risk when issuing in dollars for a country that is able to create dollars out of nothing, aka the United States. This is also referred to as the euro-dollar system. This doesn't have anything to do with euros, it's just nomenclature. And it's referring to in the 1960s when dollar-denominated bonds and credits were created in Europe to maintain solvency. So this facilitates global trade and cross-border transactions. The dollar has been referred to as a global numeraire. We see this as well in the stablecoin system, aka USDC and USDT, decide to denominate their holdings that they hold on balance sheet as assets in US treasuries nominally. Some of these may not be denominated in dollars, but their liabilities, the USDC, are always denominated in dollars. This is also useful for the pricing of commodities. So most commodities, such as Brent crude, Texas Intermediate, these are oil standards. These are priced in dollars, which means that as the dollar fluctuates, the oil price fluctuates with it, if you're not buying it in dollars, say in Europe. So the problem with being the reserve currency is that this usually necessitates a capital account surplus and a current account deficit. So this is actually a huge problem for the internal economy of the United States and has profound distributional consequences. So we see here contemporary dollar dominance. The world FX reserves at the moment are probably slightly higher than this. I think this statistic is from approximately 2015. So world FX reserves are about 60% dollar denominated. And, you know, in times of lower liquidity and liquidity crunch, this number tends to go up. That's why we see a strengthening dollar at the moment. But that's only a medium-term trend. Long-term, we would expect dollar dominance to recede slightly. Anyway, on the right here, we see global foreign public debt and how that has moved over the dollar's reserve currency status. So, like I said, dollar dominance has profound distributional consequences. Michael Pettis from Tsinghua University in Beijing has written about this at length. I can highly recommend his writings about capital flows and the balance of trade, and how the univariate measurement of export and import surpluses between countries is much too oversimplified. The real relevance is usually on the inter-country distributional effects of trading economics. An example is in China. The wealth and income inequalities that exist there help to promote cheap wages for manufacturing, which make their exports cheaper. But this is not reinvested domestically as consumption, but instead it's invested abroad, usually most predominantly, I would say, in the United States housing market, although this trend has reversed since 2020. So this is part of the investment savings part of the national accounts. So people in the West often complain about the deindustrialization of the Rust Belt, etc., but that's a very America-centric perspective. Usually it's also useful for emerging markets to consider what their internal domestic drivers are for these imbalances and how that can be changed. This is really relevant if you have sovereign currency risk because you're issuing in dollars. I'll give an example in Central Europe, where they have a lot of cross-border trade and account balances with Germany. The export surplus that they have had over the last 10 years is actually not a sign of economic health, but rather a sign that wealth and income inequality is growing faster than GDP is. This promotes domestic underinvestment that is instead spent abroad. If you have ever been to Hungary or Germany, you'll probably notice that as of recently, this is changing, but road infrastructure there is extremely poor, because even though this could be invested there, it's instead invested in American treasuries, which from a normative political judgment could be considered wasteful. Where does this fit into disaggregated credit? Well, you could ask if it's good credit creation, and if consumption and investment do not always happen in the same national jurisdiction, do cross-border flows drain out investment in that direction as well, even when done correctly? I think US securitization is a great example because it acts as a magnet draining domestic investment from surplus countries like Germany and China. You can say who the winner is here, not by national economy, but by distribution. And big surprise, it's usually the rich in both surplus and deficit current account countries who benefit. So the distributional income consequences are basically that the top 25% of Germany as an exporter and America as an importer are able to benefit from this, as well as the top 20 or so percent of the income distribution in China. It's usually the middle quartiles who suffer under these policies. So here I have an illustration of how cross-border finance is globalized. You can see that there's actually a really, really strong relationship between Western Europe and North America. This flows in both directions, but it's primarily investment from Western Europe to North America. A lot of people talk about Chinese investment in the West. This is actually usually over-exaggerated, and in my opinion, a bit of a scare tactic. What does this have to do with DeFi? Well, I would say that the collapse of the dollar standard offers an opportunity for alternative futures in reserve currency status. What this does not mean is that everything will be denominated in Bitcoin. I think that is a bit of a propaganda phrase that we've heard before from Bitcoin maximalists, and I think it's very misleading. What we can see from Ike and Green's work on how global currencies work is that there's a very high probability that the Chinese yuan, potentially the Japanese yen, also potentially the euro, will see eventual increases in the indexing of trade using those currencies as dollar dominance recedes. So they will never become a majority, but perhaps they will become a plurality of global trade indexing. Now, recent political developments in Eurasia have led to a lot of geopolitical tension that has given people political motivation to accelerate this trend. We can see this with some of the natural gas deals being done between China and otherwise sanctioned countries like Russia and Iran. So let me now get into Professor Werner's work, which hopefully you recognize from this meme, money printer go brr. Now, this is inherently a reference to quantitative easing that Professor Werner came up with in 1994 to describe the way that the Bank of Japan was increasing its money supply by doing open market operations. Here, I've amended the meme slightly by including the quantity theory of credit that disaggregates this quantitative easing into two trends. Quantitative easing aka new credit money that is created to pump up an asset bubble, usually real estate, is a good proxy to look at for this. And quantitative easing that creates new credit money for the real economy. Now, this can be seen as normatively good credit creation that we want to focus on. And of course, we have the man, the myth, the legend himself, the king of Vernonomics, Richard Werner, to thank for these theories. And let me just go over them in brief. So we have the aggregation here on the left for consumption credit. Consumption credit is similar to credit that pumps up an asset bubble because it is inflationary. Case 2 on the left here, financial credit, is referring to credit transactions that do not contribute to and are not part of GDP. So that would be to pump up an asset bubble. This also increases inflation, although maybe not consumer price inflation, maybe it's housing inflation or other assets instead. This is unproductive. On the other hand, investment credit, aka credit for the creation of new goods and services that create productivity gains, those can help give us stable growth without inflation, even at full employment. Now, here, I'll briefly talk about why small banks are very important for this and why a decentralized banking system is inherently superior in creating stable growth. We see here bank size relative to the loans they are issuing. Now, to summarize this in brief, small banks lend to small firms. Small firms, SMEs, are usually the cornerstone of economic growth. In Germany, they call these hidden champions. There are about 1,500 of them, and they are under 50 million in market capitalization, I believe, and they're really, really successful. This only works if you have a small decentralized banking system like Germany and the United States currently do. This, unfortunately, is consolidating in the Eurozone and getting worse and worse every year. Banks are essential for firms to raise external financings, and only very large firms have access to securitized bond markets. So that's credit and debt that is securitized and can be traded freely. This means that SMEs struggle to get any access to this securitized finance, and hopefully that is where DeFi and other tokenization elements can actually contribute to equalizing the playing field a bit. Here, I just have a brief illustration of the ratio of total transactions to GDP transactions and how it's relatively unstable over time. So you can see the correlation here is not very strong. And what that basically means is that there is no objective standard creating this. It is also a political choice. So with that being said, I'll return to some of these points later after giving a systemization of knowledge of the current CBDC literature about credit creation and what has been trying to address. So at the moment, CBDC does not have very much to do with DeFi. In fact, they're often bunched together inappropriately, even if there is no interoperability standard, or even worse, the CBDC, such as the Bahamian Stand dollar, is not even based on distributed ledger technology, and therefore does not really have anything to do with open access blockchains, because not only is it a permissioned blockchain, it's not even a blockchain at all. So here, I'm just going to give a short view of Martina Fraschini's work and how central bank digital currencies will have an effect on quantitative easing. Basically, the idea here is, as the previous panelist was talking about, there are two potential types of CBDC currently being discussed: wholesale and retail CBDCs. The difference between them is basically that a wholesale CBDC would be used for interbank clearing, potentially improve atomicity and atomic swaps in the repo market. So standing repo orders can be settled immediately or almost instantaneously with very little transaction lag, as opposed to overnight. And this means that netting could eventually be eliminated. This does not really have an effect on credit creation. Instead, it's only really affecting the interbank market, potentially improving lending rates or efficiency around the margins. But there are no profound consequences of this. On the other hand, if you have a retail CBDC could potentially have a totally disintermediated banking system become consolidated, where the central bank is the primary issuer of all credit. So at present, Werner's work shows that about 97% of all the credit in an economy is privately created by the commercial banking system, not by the central bank. So open market operations directly only affect 3% of the credit creation. We would see a risk shift away from commercial banks to the central bank if this was somehow changed. Like I mentioned previously, Simon Meyer has also spoken about money creation in decentralized finance and how this affects stablecoin standards. Java Shu from University College London, like I mentioned, has done great work talking about how credit creation is performed in lending markets, with reference to Werner's work, that banks hold a unique position as that of credit creator. Now, this could potentially be addressed eventually, but it's not on the cards yet. I'll reference again a statement that my colleague Borja Clavero brought to my attention, which is that when a non-bank grants a loan to another non-bank, they create a promise to pay deposits, aka a loan. Loans are not fungible with deposits; they are just different. Now, when a bank credits the account of a non-bank after a deposit of currency, those two instruments become fungible. Even though deposits are a promise to pay currency, both are considered fungible by society and trade for each other at par. Now, the question here is, what does an e-money issuer count as, aka a DeFi protocol, in this taxonomy? I would say for the moment, it would be a non-bank granting a loan to another non-bank. Even though credit is issued and it's a claim on future cash flows, the credit supply is not necessarily expanded if it's just the claim on a bearer instrument. Now, there are some potential ways that the mechanism design behind DeFi could help improve this, but we're not there yet. That's why Makoto and others in the SORA network have been looking intensely into the potential to create circular economies and how this can help improve the credit system in DeFi. And that brings us to the case for ZOR. So in the case for ZOR, Dr. Takemiya is speaking about three prerequisites that have to be met. Money has to be issued in response to genuine economic demand, while resisting arbitrary issuance, e.g. in response to political pressure, and only issued for the creation of new goods or services. It also needs to be issued in a way that enables forward guidance and sends signals about liquidity and prices. Now, unfortunately, although a lot of leveraged credit has been created in DeFi, we see these with both decentralized exchanges, such as Uniswap, lending protocols, such as Aave and Centrifuge, a lending protocol that lends into real assets slowly and is trying to make its way there. These are all either collateralized or over-collateralized to the extent that they're not able to create credit yet. We also see e-money providers like Monerium in Iceland and Saphirstein Fiat24 in Switzerland. They are not able to issue credit because they have to be over-collateralized with some kind of adequacy buffer of 3 to 4% to account for fees. Now, when we speak about Bitcoin credit creation, a fun fact about hard money monetarism, aka the 21 million capped supply of Bitcoin, is that it's not necessarily capped as said because spot markets do not yet exist and are not the prime way for retail or institutional investors on traditional finance markets to invest in Bitcoin. So what does that mean? If you have futures markets being made for Bitcoin, this might be a point of dispute, but it does actually have the ability to increase the circulating credit of Bitcoin above the 21 million cap, because some people may be speculating with futures on the same Bitcoin and increasing the amount of money that is put into it. Now, why is this not credit creation? Well, unfortunately, Bitcoin has, instead of becoming a use case asset, it's actually now slowly becoming speculative, which means that it's a savings aggregate, which by Werner's definition, actually the monetary aggregates, so M0, M1, M2, M3, when they become savings aggregates, they're actually pulling liquidity out of the market, aka reducing the amount of available credit because it's being sucked up by asset markets. What we see here is debt securities as a promise to pay side deposits, which is a promise to pay currency. As you can see, if you plot the amounts outstanding of these instruments, debt securities are usually greater than deposits, and these are usually greater than currency. So in each moment of time, the amount that is needed to settle the maturing part of the debt is smaller than the total debt circulating. This means it doesn't really have a profound effect on the credit being created yet, but it would have the potential to. Okay, now I'm just going to briefly look at the legal taxonomy. This illustration is by the Bank for International Settlements, and it discusses the different way that money is issued and settled. So what's important to know is that cash, so this is publicly issued cash by the central bank, and your bank account are not actually legally similar. because one of them is issued directly by the central bank. This would be the same as if it were issued as a retail CBDC. That's why retail CBDC is actually very similar to cash and has distributional consequences there. Whereas a bank account is issued by a commercial bank. So this is currently, by Werner's approximation, about 97% of the credit being created is commercial bank credit, not cash by the central bank. If wholesale CBDCs start to be issued, these will be issued by the central bank, but be intermediated by retail banks. So they'll be functionally more similar to a commercial bank account. So the transfer of cash, because it's a bearer instrument, is instantaneous. This would presumably be similar with the CBDC and is also the case with privately issued cryptocurrencies, because we have finality of settlement of roughly 6-10-minute blocks in Bitcoin until finality can be assured. So it's not instantaneous, but it's a lot faster than overnight. And that has consequences for the way the overnight and repurchase agreement markets would work if this were issued. So by contrast, a retail bank account can take up to 3 days to clear. That is why some people are very unhappy with the way the commercial banking system works, just from a mechanistic standpoint, and why systems like SWIFT are extremely dated and look like they are on the way out. So the difference between a legal bearer asset and a nominative instrument are that a nominative instrument is, like the Ethereum account-based model, issued to you specifically or to your MetaMask account. By contrast, Bitcoin's original UTXO proposal, that luckily the SORA network also uses, UTXO is the unspent transaction output. This is a lot closer to a bearer asset because it is not nominative. We do not yet know what a CBDC would look like if it were bearer or nominative. Hypothetically, both are possible. The tokenization standard used, for example, in Soromitsu's Bakong is a lot closer to a bearer standard, even though they are also nominative accounts. Now, if we look at the Bank for International Settlements taxonomy, we see here that permissionless cryptocurrency is widely accessible, digital, and peer-to-peer. There's a hypothetical here in the middle that central bank digital currencies that are retail will be widely accessible, digital, peer-to-peer, and issued by the central bank. Now, the reason that I do not necessarily agree with this is that I think retail central bank digital currencies do not have a high probability of being fully permissionless. Now we just have a look at the mechanism design that has been proposed in the case for ZOR and how privately issued currencies might be able to replace the Eurodollar if the numeraire, aka the unit of account, is moved from a stable coin to a freely floating asset. So that is the difference between having Binance Coin and Binance USD. Now, I think the ambition of a lot of point of sale merchants and operators like Binance is to have stuff being converted through Binance Coin rather than Binance stablecoin, but it's currently not the case, and we're a long way off from that. So I think when we're talking about ZOR, we need to think about how it has been designed explicitly to mitigate volatility risks, governance lacunae, and inefficiency of first-generation cryptocurrencies. That would be also a hard cap, which is detrimental to a credit system that is trying to grow the amount of credits circulating. So SORA is a democratic, decentralized economic system based on a blockchain network and founded to explore the capacity of cryptocurrencies to serve the productive economy. The question there is how we can actually design mechanisms and utilize the valence of the tech that is very powerful to trend away from having totally permissioned numeraire account CBDCs to some kind of free-floating bearer instrument that can maintain a level of price stability. Now, the idea in the case for ZOR is to have a sell price function, an actual sell price function that floats around the token bonding curve and gives you a margin to consolidate any fluctuations. I think this is a great start, but we need to look further into other ways to explore this. Thanks very much. I think we can do a Q&A now. I would say that it's really important when we're considering credit creation to distinguish clearly between central bank digital currencies and permissionless privately issued currencies like Bitcoin or like ZOR. Stable coins are a beast of their own because also, although they have the type of design parameters that are similar to permissionless currencies like Bitcoin because they are issued and pegged to the United States dollar. They do not maintain the Mundell-Fleming trinity, which is that you cannot have a fixed capital account, but also allow for imports and exports out of your national economy. Right. I think that should be all. If we can go to Q&A, that would be fantastic.
Yeah, so thanks a lot for the talk, Ben. There's quite a lot of interesting questions from the audience. Let's get started. So, so yeah, just one quick comment. So SORA is also not a UTXO model, it's account-based, but I think that's a good thing because the UTXO model is quite cumbersome from a computational standpoint because every token, has some kind of dust. The core advantage is, or the core principle is that the accounts are treating these assets like bearer assets because it's self-custodied and you're working directly with the blockchain, so no one can stop you from doing what you want. You can see, I guess, okay, I'll call it by its real name, Cardano. You can see how it is using UTXO model and how it's really limited their DeFi, like their DEX that could trade just one transaction per block.
Right.
So,
I think that is very correct. Apologies for misnomering SOR as a UTXO model. So I think the distinction that needs to be made there is that the UTXO is also really, really useful for determining finality of settlement because regardless of when blocks arrive, you can see what number they went out in. And so they cannot be reordered the way that has been so really, really detrimental to the arbitrage ecosystem in Ethereum, which I think is just a net burden. There's no benefit to be garnered from it. You're correct that the UTXO, it's a lot more cumbersome, and that can be an issue because you need to consider conditionalities that could happen even if a transaction fails. This basically necessitates batching or some kind of roll-up solution where intermediaries or nodes, such as a small bank or a banking union, actually settle transactions for you. I mean, if this is democratically sort of determined, if it's really democratic money, I don't see that much an issue with this. But obviously, this is a step away from self-custody and therefore less ideal. But I do think that you're totally correct that as a sort of entry point, UTXO is too cumbersome to really be workable. That is also why DeFi on Bitcoin has had such problems. Even though it's very sort of academically and ideologically sound the way they've set it up, it's really difficult to execute well.
Yeah, on the SORA network, we prioritize a lot of DeFi apps like PokerSwap. So that's why we also don't have variable transaction fees for different heuristics. And even if so also the ordering should, in theory, be first in, first out for correctly working nodes. Obviously, somebody could tweak their own node, but it's well, I mean, they wouldn't know when they're going to be block producer because of the way the block production works. So another cool thing about modern technology, unlike Ethereum or Bitcoin, is that you do get transaction finality in substrate via Grandpa. And so that means that typically after 3 blocks, you get a finality, and you actually can make a proof of the finality that is useful for things like bridging between chains. And this can just get better over time. So there's a lot of questions that the community has. I'll just go in order. So somebody asked, what's your opinion on Zor? Do we have any competitors to Sora?
I think it's tricky to determine. What I would say is that there is basically no decentralized exchange or non-custodial wallet that has a development team contributing to it that has also contributed to the design of a central bank digital currency with the Hyperledger Consortium, other than PokerSwap. This gives you a huge advantage for interoperability standards. I know that a lot of really, really good DeFi protocols like Curve Finance and StableSwap, they are looking to have interoperability standards. I don't know how far those ideas have progressed, but they certainly would like to have Forex markets interacting directly with their protocol. I think that if you look at what the legacy system is using for atomicity swaps, that's usually R3 Corda, which is a permissioned enterprise software competitor to Hyperledger. You basically would need familiarity with some of these systems to really know about interoperability standards. And of course, everything that is building on the parity substrate system has really been sort of optimized for interoperability. So I think there's a huge advantage there. I would say competitors are ones who have adapted to the EVM standard, which is, like it's the biggest by far, and the standardization has led a lot of stuff to be interoperable with it that also uses EVM. However, it has a few technical shortcomings that people do not like.
That's like saying a chair is a competitor to toilet, though. But
as long as they're both comfortable.
Yeah, but I was at the Hyperledger Global Forum last week, and one of the roundtables was about interoperability standards. And the problem with interoperability standards is everyone creates their own standard, and there's no interoperability. It is what it is. It's a very fragmented space right now, and no one really wants to talk to each other. So people doing interoperability in Hyperledger are not talking to people at Web3 Foundation, who are not talking to people in Cosmos. And it's all just, very much ad hoc and based on political games for the most part, which is, it's how humans are. Man is a political animal, right? So another question is that, hi, Ben, historically, reserve currencies have gone through cycles going from hard currencies to hard-backed and eventually to fiat. I think they mean like commodity backing. With the overwhelming distrust in fiat, do you think it's possible that the next reserve currency will be a hard currency? So, for example, there's rumors about BRICS talking about making a gold-backed currency.
Right. So I think that a really key thing you have to think about when you talk about a commodity-backed currency, I think this is something of a shortcoming with Bitcoin's analogy as digital gold, is that if you have a commodity-backed currency, like the gold standard was, it is not necessarily backed one-to-one. If you have the euro-dollar system creating credits, so this is between approximately 1965 and 1973, you had an expansion of the money supply, even though it was backed by gold and could be redeemed by gold until you hit your collateralization ratio, just like a stablecoin. The assets and liabilities have to match, but as long as you keep the claim on future cash flows, which is a part of what money is, as long as you keep that circulating, you do not necessarily have to have full backing. So I could see, for example, some kind of productive commodities. So gold is really not a good example here, but productive commodities that are predictable in price and supply, like natural gas. I could see countries that maybe have trouble getting access to the dollar system and the repurchase agreements, issuing something that is not one-to-one backed by gas, but maybe there's 4 times the amount of the resource commodity circulating than there is natural gas, that can be redeemed up to some kind of level. But you basically need to maintain a circulating economy to prevent redemption crises from happening. And I mean, this has historically also been what sovereign debt crises are, such as the 1998 Asian debt crisis, because the commodity they were backing themselves with were dollars. They may not be backed by anything, but you have to treat them as if they are, which, is unfortunate. And we're looking to change that. So hopefully, in the future, I hope you're right.
Well, I mean, gold is also heavily manipulated, and you have to ask who owns the gold. So there was a book written around 100 years ago called, I think, The Fraudulent Standard, which talked about how gold standard was pushed through because certain people had the gold. And
and I would also add, as a Swiss who is familiar with the amount of gold that is not evenly distributed, something that you have to consider is that a lot of extremely imprudent sales of gold happened with the Bank of England at its all-time low price around 2002, where Gordon Brown sold it. So I think maybe there's often an easy solution to dumping your gold if you have no accountability for where it goes.
Is it true that Swiss shower with gold instead of soap?
Sometimes. Only in winter.
Yeah. Cold winter. So yeah, that's a really good point. But yeah, I'm always kind of skeptical about these commodity-backed currencies. I mean, like especially gold. Like there's one asteroid I think that has more gold than the whole Earth, and you wouldn't want to like say your money's worthless now that some rock hit your planet. So I think I think it's better to have some other type of rules governing the scarcity, because you do need scarcity, otherwise money is not really valuable. But it doesn't, as we see with the fiat system, it doesn't have to be it doesn't really have to be backed by anything, as long as there's as long as it's backed by violence, basically. One of the questions is, what kind of killer applications would be able to be built on SORA if the token bonding curve reserves are filled?
Great. I actually am glad that you got to this because I was discussing this a few months ago with my colleague Borja. Maybe you can ask him about it later as well if you're interested. But something that Borja thought would be really useful in having a currency that is a true bearer instrument that can be measured is you can see what degree of money creation is actually used in transactions. You could test it and see if VR is stable. So that's in Werner's disaggregated theory of credit creation. VR is the true measure of money actually used for GDP transactions. And you can have some kind of reward system that is helping that to be incentivized. So you could perform mechanism design that has the disaggregated part going towards credit creation for asset purchases, disincentivized, because at present interest rate policy is a proxy for the incentive to pump up an asset bubble. And instead you can have that incentivized by some kind of token issuance model, which is similar. Yields are similar to yield farming. I mean, they're both kind of an interest rate in that you're getting more of the same numeraire, but you could instead have, some kind of system that is correctly modeling what is going towards an asset bubble and what is going towards productive credit for real GDP transactions. And obviously, UTXO could help with this, but that is more of a opinionated point than actually actionable.
Well, yeah, I think you can still do tracing. I think honestly more easily without UTXO. But I thought about doing a similar analysis. I didn't have time to do it before the SCF, but basically we know via referendums and also other distributions like what invoices were paid in the SORA network and that these were created to build things, and then we can track the money across the different hops to kind of see where does it go without having a country using ZORA as a legal tender. Unfortunately, for daily expenses, you do have to exit the SORA economy. And that's where circularity is really important because otherwise you do have a constant drain on the liquidity. And if we were a big economy, obviously it wouldn't matter so much. But as a small economy, it's kind of hard on liquidity. And of course, it's not assets that you own, it's the liquidity that really matters.
And something that I would add is that counterintuitively, if you look at some of the intermediaries, for example, in Latin America, who are looking into using Binance point of sale technology, Binance is an exchange. If you're paying with ZOR there, it will be converted into some kind of stablecoin. So ironically, if you're doing that, the more your ZOR is used in a circulating economy, because the API interaction actually involves a quick swap being done, that creates downward price pressure. So actually the incentive there is to have no circulating economy, which unfortunately, in my opinion, is what we have seen with Bitcoin. They don't like to see Bitcoin payments because Bitcoin circulating creates downward price pressure when, that really upward price pressure should not be the goal of the Bitcoin system, like the monetary policy of it as designed. But that is sort of where the intentionality has slowly headed over the last few years.
Well, also, more use in payments increases velocity, which can also have an effect on the price level. But as long as it doesn't exit the economy, it's not that bad, I think. The SORA card will help a little bit just because you would exit only when you make a purchase. So right now, people to pay expenses, just will exit into like euros or other fiat currencies, just in preparation for the future. But if they have a card that's on demand, then it can change the dynamics. So it's only used when actually people spend the money. So that can help in that case. I do think the payment processor we're working with also should be able to accept ZOR if the merchant chooses to accept ZOR. Now the problem is going out and getting these merchants on board. Really, what you need is your own brand to compete with Visa or MasterCard, but that's a very tall order, to say the least.
The demand is there to compete with Visa and MasterCard because their brands are established, but they're not popular. I can assure you that.
Yeah, and I thought the whole master-slave terminology is anti-woke.
Yes, well, that's a point for a different person to ask. I can't comment.
So somebody else asked, in your opinion, what would be a good synthetic asset if not the US dollar?
Right. So I think the terminology of a synthetic asset for the US dollar is slightly misleading because, like I said, global reserve currency status and the ability to sort of provide repurchase agreement liquidity to other central banks means that you have a hierarchy where you do have claims on future cash flows that can be generated. And that's not just US taxes. That is also any kind of commodity or taxation or productive GDP that is being produced in a country that is demanding US dollars. So that being said, my personal opinion would be basically anything would be a better synthetic asset than that.
Well, I think using other types of cost of goods indices would be the way to do it in the future. That's actually one of the goals in the future, is to denominate the SORA token bonding curve in something like that. We can do it already just through governance updating the token bonding curve price points, like to match some macro trends. But anyway, without reserves, we're not there yet. I think we'll just ask another question. Will SORA and Valhalla have a dexual relationship?
I think.
What are the plans for collaboration?
For sure. Yeah.
Can you convince Oliver and the guys to build on SORA?
I can certainly put out a proposal. I think it will be a great idea, but first you need to let me know when you're looking to adopt UTXO. Just joking. Yeah.
Yeah, I'm not a fan of UTXO, but yeah, no, I do think that there's a lot of commonalities in the philosophy of the communities, and so it could be quite helpful. Thank you a lot for your time today. I really liked the presentation, Ben, and yeah, have a good day.
Thanks very much.
We'll be back.
Always hoping that our ecosystems can see future synergies. Right. Take care. Thanks very much, guys.
Thanks.